Okay, let's unpack this. You've asked us for a deep dive into the dynamic world of India's financial regulations. We're talking about the very latest updates from heavyweights like the Reserve Bank of India, the RBI, and the Securities and Exchange Board of India, SEBI. Our mission today is really to cut through the jargon. We wanted to extract the most important nuggets of knowledge from, a whole range of official circulars, detailed analyses, recent news. Think of it as your shortcut to being truly well-informed on these crucial developments, maybe with a few surprising facts along the way.
Yeah, and what's fascinating here, I think, is how these seemingly disparate updates. I mean, everything from how government bonds are traded to new guidelines for gold loans, even initiatives promoting books, how they actually connect, they really paint a comprehensive picture of an evolving financial landscape, one that's, both modernizing and safeguarding its foundations.
Right, modernizing and safeguarding, that's a key tension. So let's start with the RBI's recent shift. We're kicking things off with something called STRIPS, that's STRIPS, separate trading of registered interest and principal of securities. So imagine taking a regular government bond and literally breaking it into its individual interest payments, the coupons, and the final principal repayment. Each of these can then be traded separately, almost like a zero coupon bond, right?
Exactly like a zero coupon bond, yeah. Each piece becomes its own security.
Now, what's the big news here, and why is this particularly significant now for state government securities, or SGS?
Well, the big news is the RBI's decision to now allow this for state government securities. This is, frankly, a game changer because previously this facility was primarily available only for central government bonds. That system has been in place since, 2010? So extending it to states is huge. And the RBI has also clarified that SGS will be eligible for reconstitution, which is, just the reverse process, putting the pieces back together into the original bond.
Okay, so if you're a state government, this sounds like it could open up new avenues for funding, maybe make their bonds more attractive. But are all state bonds eligible? Or are there specific criteria they need to meet? Like, can any state just do this?
No, not all bonds qualify. They have to be fixed coupon bonds issued by state governments or union territories. They need a residual maturity of up to 14 years, a minimum outstanding amount of, I think, RSS 1,000 crore. And crucially, they must be eligible for banks' statutory liquidity ratio, the SLR requirements.
Okay,
Essentially, you're looking at large, stable, and transferable bonds, not just any small issuance.
got it. And for market participants, the people actually doing the trading, how do they go about unbundling or reconstituting these bonds? Is it a clunky manual process, or has the RBI streamlined it?
Thankfully, it's largely streamlined and digital. The process involves placing requests directly in the RBI's eCuber system. That's their core banking solution. So whether you're a big institutional player with a direct SGL account, or maybe a smaller investor working through a custodian with a CSGL account, the aim is enhanced efficiency and direct access. It makes the market more responsive.
Right. So let's bring it back to the listener.
Yeah.
What does this all mean for you, especially if you're maybe managing investments for a large, long-term player like an insurance company? How does this flexibility translate into real-world benefits?
It's a genuine game changer for them, especially for anyone who needs really precise cash flow management. Think about insurance companies. They can now better align their investment income with future payouts to policyholders by buying specific interest or principal strips from state bonds.
Okay, so matching income to liabilities more precisely.
Exactly. And by buying these strips at a deep discount, because they're essentially zero coupon, they gain a yield advantage and significantly reduce reinvestment risk. The risk of having to reinvest small coupon payments at potentially lower rates.
Makes sense. And are we seeing this take off?
Well, we're already seeing significant growth in this area for central government bonds, the GSECs. I saw figures showing trades increasing from around 38,000 crore in FY20 to, get this, 2.47 lakh crore in FY25.
Oh.
Yeah. So this move now democratizes access to parts of state bonds. It could potentially broaden the investor base for state governments and definitely enhance market liquidity for SGF.
Okay, fascinating. From dissecting individual bond components, let's pivot to something, well, massive. The financing of large-scale infrastructure and real estate projects across India. The RBI has just introduced comprehensive new rules, the Project Finance Directions 2025. When do these rules kick in, and who exactly do they apply to? Is it just banks?
No, it's comprehensive. These new rules apply right across the board: banks, non-banking financial companies, NBFCs, cooperative banks, basically all other regulated entities. And they're set to take effect from October 1st, 2025. So institutions have some time to prepare.
Okay. And what's at the core of these new directions? Is it primarily about increasing safeguards for lenders, maybe making them set aside more capital? How does that manifest?
That's exactly it. The core involves significantly revised provisioning requirements. Basically, lenders have to set aside more capital as a buffer against potential losses. For projects still in the construction phase, the provisions for commercial real estate, CRE, exposures, and other portfolios are notably higher now. It reflects their inherent risk at that stage.
Hmm.
Once projects become operational, start generating revenue and repayments begin, these provisions typically decrease, acknowledging that the risk profile has improved.
That makes logical sense. Risk goes down, provision goes down. And what about delays? Project delays are, let's face it, a common challenge in these large-scale ventures. How do the new rules address that particular headache?
Yeah, delays are a big focus. There's an extra layer of protection built in. If commercial operations are delayed beyond the original schedule, lenders face additional provisioning requirements. It ramps up quarter by quarter.
So an incentive not to let things drift.
Precisely. And the guidelines also revise the permissible extension for the date of commencement of commercial operations, the DCCO. Infrastructure projects can get up to 3 years extension, while non-infrastructure, including CRE, are capped at 2 years. The underlying aim is really to push regulated entities towards a more principle-based approach for resolving stress in these loans rather than just, kicking the can down the road with endless extensions.
Right, more proactive management. Now, there's an important grandfathering clause, isn't there, for existing loans?
Yes, that's important to note. Loans that were disbursed and achieved financial closure before October 1st, 2025 will be exempt from these new norms. They'll continue under the existing guidelines.
Okay. So how might this impact the major lenders, especially those heavily involved in project financing? You mentioned PSC and RAC earlier.
Right. This move will significantly impact major lenders like Power Finance Corporation, PFC, and Rural Electrification Corporation, REC. They're both based in New Delhi, as you know. Given their combined exposure, it's massive, over Rs 16 lakh crore in project loans, they will absolutely need to adapt their capital allocation strategies. They'll have to hold more capital against these loans under the new, more stringent provisioning requirements.
So it's a clear signal from the RBI for greater financial discipline in large-scale lending, a buffer-building exercise.
Definitely. It's about strengthening the foundations for these critical but often risky long-term projects.
Okay. Now, let's talk about something called priority sector lending, or PSL. For those listeners who might not be fully immersed in this, can you quickly explain what PSL is and why it's such a critical tool for the RBI?
Sure, PSL, Priority Sector Lending, is a really crucial policy initiative. The RBI essentially requires banks to allocate a specific portion of their loans to sectors that are traditionally underserved or vulnerable. Think agriculture, micro, small and medium enterprises, MSMEs, education, housing for lower income groups. It's fundamentally about ensuring credit flows to segments that are vital for inclusive economic growth.
Right, ensuring finance reaches all parts of the economy. And what's the key change now specifically for small finance banks, or SFBs, regarding their PSL targets? And when does this change kick in?
Okay, so the RBI has revised the PSL norms for small finance banks. This will be effective from April 1st, 2025, so for the financial year 2025-26. The really significant change is a reduction in the overall PSL loan target for SFBs. It's coming down from 75% of their total loans to 60%.
From 75% to 60%.
Yeah, and this aligns them with urban cooperative banks, the UCBs. Their PSL target was also reduced to 60% back in March 2025, so it brings some parity there.
Okay. How exactly are these targets calculated? You hear terms like adjusted net bank credit, ANBC, and credit equivalent of off-balance sheet exposures, CEOBE. For our listeners, what do those actually mean in practical terms?
Right, those acronyms can be a bit much. When we talk about how these targets are calculated, it's basically based on a bank's total lending capacity or their overall credit exposure. ANBC, Adjusted Net Bank Credit, covers the money they've actually lent out directly, plus certain investments. CEOB, credit equivalent of off-balance sheet exposures, accounts for potential credit risk from commitments they've made but haven't yet paid out, things like bank guarantees, letters of credit, even complex derivative contracts like forwards and options.
So it's trying to capture the full picture of their risk-taking.
Exactly. The goal is to get a comprehensive measure of their overall exposure, ensuring the PSL targets are met against their full financial footprint, not just their loan book.
Okay, so under this new structure, with the target reduced to 60%, How will the SFBs reach that? Is the internal allocation changing? And I understand there's a unique restriction for them compared to other banks when it comes to meeting these targets. Can you elaborate on that?
Sure. So under the new structure, SFBs will continue to allocate 40% of their A and BC or CEOB, whichever is higher, to specific predefined PSL subsectors. That core part remains. However, the additional allocation, where they could previously lend up to 35% to any PSL subsector where they felt they had a competitive advantage, that part is being reduced to 20%.
So 40% specific plus 20% flexible gives the new 60% total.
Precisely. And the restriction you're hinting at is quite interesting. Unlike other banks, small finance banks are explicitly not allowed to sell priority sector lending certificates or PSLCs.
Ah, the PSLC market.
Yeah. PSLCs are basically tradable instruments. Banks that exceed the PSL targets can sell this credit surplus to banks that fall short, but SFBs are barred from this market.
Why is that?
The thinking is to ensure SFBs remain focused on direct priority sector lending in their specific niches. Rather than just buying certificates to meet their targets, it reinforces their core mission.
Right, keeps them focused on the ground level lending. Okay, from the broad strokes of lending targets, let's get into the specifics of a very tangible asset: gold. The Reserve Bank of India has issued draft guidelines for banks and NBFCs regarding gold loans to individuals. What are some of the standout new requirements for borrowers and lenders here?
But one key aspect everyone's watching is the loan-to-value ratio, the LTV. The general rule is that the loan amount cannot exceed 75% of the value of the pledged gold.
So that revises the temporary 80% relaxation that was put in place during the COVID-19 pandemic?
Exactly. That temporary measure is being rolled back. However, there's an important nuance here. Other proposed guidelines suggest a higher LTV, potentially up to 85%, but only for small loan amounts. Specifically, those up to 2.5 lakh. And these small loans also wouldn't require a detailed credit appraisal. The idea is to ease access for low-income borrowers who might need quick liquidity against small gold holdings.
Interesting balancing act. And when are these likely to come into effect?
These guidelines are anticipated to take effect from April 1st, 2026. So again, some lead time.
Okay. Beyond the LTV, what other crucial requirements should someone considering a gold loan be aware of? What sort of paperwork or certification is involved now?
Borrowers will need to provide proof of gold ownership. If they don't have original receipts, a suitable declaration might suffice. And lenders, on their part, must issue a detailed certificate. This has to specify the gold's purity, its weight, any deductions made, and crucially, the assessed value used for the loan calculation. It's all about ensuring transparency on both sides of the transaction.
Transparency, right. And this is fascinating. It's not just gold anymore, is it? But forget something about silver. Can other precious metals be pledged now? And are there limits on the quantities?
That's a really interesting development. Importantly now, it's not just gold ornaments or coins. Specially minted silver coins, provided they have a minimum 925 purity and are sold by banks, can also be pledged as collateral.
Silver coins too, okay.
Yes. And there are also limits on the items pledged, likely to prevent misuse or large-scale speculation. For gold ornaments, it's up to 1 kilograms per borrower. For gold coins, it's up to 50 grams. For silver ornaments, the limit is up to 10 kilograms, and for those newly allowed silver coins, it's up to 500 grams per borrower.
Okay. Specific limits. Now, here's a critical detail for you as a borrower, something that adds a real layer of protection. What happens if the bank doesn't return your gold promptly after you've fully repaid the loan? Is there a penalty?
Yes, and this is a major safeguard for borrowers. If the gold isn't returned within 7 working days after the loan has been fully repaid, the bank is liable to pay a penalty.
How much?
It's Rs 5,000 per day to the borrower. That's a significant deterrent against delays. The guidelines also mandate very transparent auction processes in case of default. The reserve price in an auction must be at least 90% of the prevailing market value. And importantly, if the auction fetches more than what's owed, any surplus must be returned to the borrower within 7 working days. It's really about greater accountability and fairness in the process.
Much needed protections. Okay, from the tangible asset of gold and its regulations, let's pivot to something equally fundamental to financial security: your identity. The RBI has released a draft circular aiming to simplify the Know Your Customer, or KYC, process. KYC, of course, is what financial institutions use to verify customer identities and prevent illegal activities like money laundering. What are the key proposals designed to make this process easier, less of a hassle for customers?
Well, there are several key proposals aimed at convenience. Firstly, customers will now be able to update their KYC details at any bank branch. Doesn't have to be their home branch. It can be a non-home branch, too.
Oh, that's helpful.
Yeah. Banks are also permitted to use the Video-Based Customer Identification Process, VCIP, for remote KYC updation, subject to availability, of course. Makes it easier if you can't physically visit a branch. Additionally, business correspondents, the BCs who often operate in rural or remote areas, can be authorized by banks to collect KYC documents and even assist in reactivating dormant accounts. It's about bringing services closer to the customer.
That sounds like a significant boost to convenience, especially remote updation. And when it comes to how often we need to update our KYC, are there clearer, perhaps risk-based timelines now? Is it still the same for everyone?
No, it's moving towards a clearer, risk-based approach. The term updation itself is being replaced with periodic updation to be more specific about timelines. The key here is differentiation based on risk. High-risk customers will need to update their KYC every 2 years. Medium-risk customers every 8 years. And low-risk customers only every 10 years.
10 years for low risk. That's much less frequent for most people.
Exactly. It's designed to be more efficient and, frankly, less burdensome for the average customer while still maintaining necessary checks for higher risk profiles.
So how does this new approach leverage technology? Is it aiming to avoid duplicate document collection and integrate better with existing systems like the central KYC registry?
Yes, definitely. The draft emphasizes much stronger integration with the Central KYC Records Registry, or CKYCR. Financial institutions will be required to upload or update KYC records in CKYCR within 7 days of receiving new customer information or completing an update. And for onboarding customers for new services, they are strongly encouraged to use the existing CKYCR KYC identifier if available. The idea is to avoid repeatedly asking customers for the same documents, unless, of course, the existing data is outdated or incomplete.
Right, trying to create a single verified source of truth for customer identity across the system. Makes sense.
It's all about efficiency and reducing friction for both customers and institutions.
Okay, let's move into Section 2. RBI's forward-looking and digital initiatives. Let's turn to an innovation that promises to truly reshape how credit is accessed in India, the Unified Lending Interface, or ULI. The Department of Financial Services recently held a high-level meeting focused specifically on scaling up this RBI initiative. So what exactly is ULI, and why is it considered so revolutionary for digital lending?
ULI is essentially an application programming interface, an API-based digital platform, and crucially, it's consent-driven. What this means, in practice, is that with a borrower's explicit permission, banks and financial institutions can seamlessly and securely access authenticated data directly from multiple verified sources.
Like what kind of sources?
You think Aadhaar for identity, land records, tax filings from the IT department, GST data, KYC information already held elsewhere. It pulls it all together electronically. It's envisioned as a form of digital public infrastructure like UPI but for credit. It was developed by the Reserve Bank Innovation Hub, RBIH, and officially announced in 2024.
Okay, digital public infrastructure for credit. So for you, our listener, how does this translate into a practical difference when you apply for a loan or seek credit? What's the immediate benefit you might see?
For you, the borrower, this translates hopefully into a faster, much more transparent, and significantly less cumbersome process for accessing credit. Lenders can quickly and securely verify your information without needing reams of physical paperwork that you have to collect and submit. This could potentially speed up loan approvals dramatically and reduce the friction in the whole lending ecosystem.
Less running around, faster decisions. Sounds good. Now, shifting gears from digital lending to a major global challenge, climate change. The Reserve Bank of India has launched a new initiative called the Reserve Bank Climate Risk Information System, or RBI CRIS. This platform is designed to address, well, persistent data gaps in climate-related financial information. How does RBI CRIS actually work, and what are its main components?
Right, RBI CRIS operates with two main components. First, there is a web-based public directory. This lists various climate-related data sources that are out there, things like meteorological data, geospatial information, basically a signpost to existing resources.
Okay, a public directory. And the second part?
The second part is a restricted access data portal. This provides processed and standardized data sets specifically to regulated financial institutions, the banks, NBFCs, etc. It's a dual approach. Public information pointing, and restricted, curated data for the institutions that need it for risk assessment.
That's a smart way to manage data access and sensitivity. The platform aims to identify and standardize data gaps in three critical areas: physical risk, transition risk, and carbon emissions.
Hmm.
Can you unpack what kind of risks we're really talking about here? Physical and transition risk, what do they mean in a financial context?
Absolutely. Physical risk arises directly from the physical impacts of climate change, natural disasters like floods, droughts, cyclones, heat waves. So it requires data on geographic susceptibility, maybe historical financial losses linked to such events.
Okay, direct damage and transition risk.
Transition risk is a bit more subtle. It stems from the economic and societal shifts that happen as the world moves towards a low-carbon economy. Think changes in policy, like carbon taxes, shifts in technology, like EVs replacing combustion engines, or changes in market sentiment, investors avoiding fossil fuels. This needs data on things like sectoral greenhouse gas emissions, carbon pricing impacts, stranded asset risks.
So it's about understanding how both the changing climate itself and our response to it impact financial stability and individual institutions.
Precisely. RBI CRIS aims to provide the data foundation for banks and others to start quantifying and managing these complex risks.
Okay. Now, in a truly unique and, I think, quite interesting move, the RBI has launched a special scheme to promote original book writing in Hindi, specifically focusing on subjects like economics, banking, and finance. Who is the scheme aimed at, and what are the criteria for participation?
Yeah, this is a lovely initiative. The scheme encourages working or retired professors, associate professors from UGC-recognized universities to write and publish in Hindi. The key criteria are: the book must be originally written in Hindi, so not a translation. It needs to be at least 20 pages long. And it must have been published within a specific window between April 1st, 2024 and March 31st, 2025 for the current round.
Okay, so it's promoting original scholarship in Hindi on these important topics. How does the RBI recognize these authors? What are the incentives for them to contribute?
Each year, the RBI plans to select 3 top entries for awards. Each winner will receive a prize amount of Rs 1,025,000. The books will be evaluated by a special book review committee based on 60% for content quality and 40% for language and writing style.
So a real incentive.
Absolutely. It's a clear investment in the intellectual capital of the country and, importantly, promotes financial literacy and accessibility of these complex subjects to a much wider Hindi-speaking audience.
Great initiative. Okay, let's move into Section 3, India's growing integration into global finance and market infrastructure. And this is a big one. India has officially become part of JP Morgan's Government Bond Index Emerging Markets, or GBIEM. The inclusion started on June 28, 2024. How significant is this really? What kind of impact is it projected to have on India's financial landscape? Is it just about bragging rights?
Oh, it's far more than bragging rights. This inclusion is projected to bring significant foreign investment into Indian government bonds. Estimates range around 25 billion US dollars flowing into the country over the next 10 months alone.
20 to $25 billion.
Yes, with potentially $2-3 billion coming in every single month during the phase-in period. This isn't just about the dollars flowing in, though. It's a powerful vote of global confidence in India's macroeconomic stability and the growing maturity of its bond markets. It signals a shift, perhaps, from seeing India as just an emerging market to a more integral part of the global financial architecture.
And the tangible effects.
Well, it should boost India's foreign exchange reserves, potentially strengthen the rupee, although the RBI will manage that, and help manage overall external finances. India is expected to reach the maximum weight of 10% in the GBIEM Global Diversified Index eventually.
So for you, the listener, this means potentially a more robust and liquid Indian bond market. It could help lower the government's funding costs, maybe just slightly, but importantly, support the further development of domestic capital markets. Now, what kinds of Indian government bonds, IGBs, are actually eligible for this index? Is it all of them? And how does that affect foreign investors wanting to participate?
No, it's not all of them. Only Indian government bonds designated under the Fully Accessible Route, or FAR, are index eligible. This FAR route was specifically introduced by the RBI back in 2020 precisely to enable non-residents to invest in specified government securities without the usual restrictions. It was a key step in paving the way for this kind of index inclusion.
Right, laying the groundwork. Now, you've laid out the significant benefits of these bond inflows, the investment, the confidence signal. But let's consider the flip side. Will the sheer volume of foreign currency inflows pose a challenge for the RBI, specifically in managing the rupee's stability and potential inflationary pressures?
That's a crucial question, and one the RBI is undoubtedly focused on. When large amounts of dollars flow in, if the RBI intervenes to buy those dollars to prevent the rupee from appreciating too rapidly, it must release an equivalent amount of rupees into the banking system.
Injecting liquidity.
Exactly. So while the inflows are good for reserves and the rupee generally, the RBI will indeed need to actively use instruments in its toolkit, things like open market operations, selling bonds to absorb rupees, or adjusting reserve requirements to sterilize these inflows and manage potential inflationary pressures arising from that increased rupee liquidity.
So it's a delicate balancing act.
Mhm.
Welcome the inflows, but manage the consequences.
Absolutely. It requires skillful management, which the RBI has demonstrated in the past.
Okay, now in a parallel move, almost complementing this global integration, SEBI, the Securities and Exchange Board of India, during its 210th board meeting, approved some compliance relaxations, specifically for foreign portfolio investors, FPIs, but only those investing solely in Indian government securities, or GSECs. First, maybe remind us what are the key routes FPIs currently use to invest in Indian debt, and has anything changed recently regarding overall investment limits?
Sure. FPIs currently invest in Indian debt primarily through three major routes. There's the general route, the voluntary retention route, VRR, which has specific conditions, and that fully accessible route, FAR, we just discussed for GSECs. And yes, there was a notable change recently. The RBI's latest master direction on non-resident investment increased the FPI investment limit for corporate debt securities quite significantly, from 9% up to 15% of the outstanding stock. That reflects growing confidence and demand for Indian corporate bonds, too.
Okay, 15% for corporate debt now. So back to the GSECs FPIs. What are the specific relaxations SEBI has approved for them? How does it make compliance easier for these particular government bond investors?
Right. For FPIs investing only in GSECs, SEBI has made a couple of key changes. First, the mandatory KYC review periodicity, how often their Know Your Customer details need to be refreshed, will now be aligned directly with the RBI's norms, which, as we discussed earlier, are becoming more risk-based and less frequent for lower-risk entities.
Less paperwork, fewer reviews.
Exactly. Also, FPIs investing solely in GSECs under that 4 route will no longer need to submit detailed investor group details. This information is primarily relevant for monitoring potential takeovers or concentration risks in equity and corporate debt markets, so it's less relevant for pure GSEC investors.
So removing requirements that weren't really adding value for this specific category, that sounds like a clear step forward for ease of doing business, reducing red tape. But does this also have any implications for, say, non-resident Indians, NRIs, overseas citizens of India, OCIs, or even resident Indians who might be part of these FPI structures?
Yeah.
Does it open doors?
Yes, that's another significant aspect if we connect this to the bigger picture. These relaxations also effectively allow NRIs, OCIs, and even resident Indians to be constituents within these GSECs FPIs without being subject to some of the usual investment restrictions that might apply if they invested directly or through other FPI types.
Interesting nuance.
Yeah. Additionally, the timeline for reporting any material changes for these specific FPIs has been standardized to a uniform 30-day window, simplifying compliance further. Oh, and just as a related point on taxation, it's worth noting the Finance Bill 2025 proposes to tax long-term capital gains, LTCG, from all FPI assets, including listed debt, at a rate of 12.5%. plus surcharge and cess. That's up slightly from the previous 10% rate for some debt instruments.
Okay, so easier compliance on one hand, but a slight uptick in the LTCG tax rate proposed. Good to keep in mind. Now, SEBI has also been busy innovating for investor safety and market structure more broadly. First up, they've launched a new UPI-based payment mechanism called VALID. This is set to be mandatory for all investors dealing with market intermediaries, brokers, mutual funds, etc., from October 1st, 2025. How does VALID enhance security in market transactions? What's the core problem it aims to solve?
The core problem VALID tackles is impersonation and fraud. Unregistered entities sometimes try to trick investors into sending them money, pretending to be legitimate brokers or advisors. This system aims to combat that by ensuring investors transfer money only to verified SEBI-registered intermediaries. VALID is essentially a unique UPI-based payment ID issued exclusively to these registered entities.
How can you tell it's valid?
Each UPI ID will include a specific handle, @valid, combined with the bank name. And visually, there should be a green thumbs-up icon displayed in the UPI app to assure authenticity. It's about creating a clear, verifiable signal of legitimacy for payments. SEBI has also set a daily UPI transaction limit of Rs 5 lakh, specifically for capital market payments using this system.
Okay, a visual cue and a unique handle. And to empower you, the investor, even further, SEBI is also introducing a verification tool alongside this called SEBI Check. How will that tool help you confirm the authenticity of these payment IDs?
Right. SebiCheck is designed to give investors direct verification capability. Also launching from October 1st, 2025, this tool will allow you to verify any @valid UPI ID. You can either scan a QR code associated with the ID or manually enter the ID into the tool. It'll then confirm key bank details like the underlying account number and IFSC code of the SEBI registered intermediary linked to that UPI ID.
Ah, so you can double check that the ID truly belongs to the entity you think you're paying.
Exactly. It provides an extra layer of assurance, putting verification power directly in the investor's hands before they transfer funds.
Good safety measure. Next, let's talk about co-investment. This is an investment strategy where certain investors invest directly alongside a main alternative investment fund, an AIF, in the same deal or company, but kind of separately from the main fund pot. SEBI has just approved a new framework for this. What does this new co-investment vehicle or CIV model entail, and who's it designed for? Is it for everyone?
No, it's definitely not for everyone. SEBI has approved this new co-investment vehicle CIV model. These CIVs must be structured as a specific scheme under either a Category 1 or a Category 2 AIF, those dealing typically with venture capital, private equity, or debt funds. These CIVs will allow investors from any scheme of an AIF managed by the same fund manager to co-invest, but only in unlisted securities of companies where the main AIF is already investing. And critically, co-investment through these CIVs is restricted to accredited investors.
Investors. Who are they?
These are essentially sophisticated investors, high net worth individuals or institutions who meet certain financial criteria and are recognized by SEBI as having the capacity to understand and bear the risks associated with complex, illiquid investments like those in AIFs. So it's aimed at the professional end of the market.
Got it. Now, in a related move, maybe filed under ease of doing business, SEBI has also relaxed the minimum and maximum investment limits for angel funds. How will this change impact the ability of these funds, which specifically back startups and early-stage companies, to deploy capital?
This is quite significant for the early-stage funding ecosystem. The revised range for investment by an angel fund in a single investee company is now much wider, from 10 lakh at the lower end up to 25 crore at the higher end.
How was it before?
The early range was 25 lakh to 10 crore, so the floor has been lowered, allowing investment in very nascent ventures, and the ceiling has been raised significantly, allowing them to participate in larger follow-on rounds for more developed startups.
More flexibility at both ends.
Exactly. Plus, another important change. The previous 25% concentration limit, meaning an angel fund couldn't put more than 25% of its total corpus into a single company, that limit has been removed entirely.
Oh, wow. So they can make bigger, more concentrated bets if they choose.
Precisely. It allows them to back their winners more strongly or tailor their portfolio construction with greater freedom.
Okay. Finally, within SEBI's recent innovations, they've introduced a comprehensive framework to regulate the issuance and listing of environmental, social, and governance ESG debt securities. Now, the announcement specified this framework applies to social bonds, sustainability bonds, and sustainability-linked bonds, SLBs. But importantly, it explicitly excludes green bonds. Why this exclusion, do we think? And what standards must these other ESG instruments comply with?
The exclusion of green bonds is likely because green bonds often have their own, quite established and specific guidelines and frameworks already in place, both globally and sometimes nationally. SEBI might be avoiding duplication or conflict there. For the bonds covered by this new framework, social, sustainability, and SLB's eligibility requires compliance with internationally recognized standards. This is key for credibility. Examples mentioned include the International Capital Market Association, ICMA principles, like the Social Bond Principles or Sustainability Bond Guidelines, the Climate Bond Standard, CBS, or the Association of Southeast Asian Nations, ASEAN Standards, or indeed any relevant guidelines issued by Indian financial regulators themselves.
So aligning with global best practices. Now, if I'm an issuer or an investor looking at these, how do social bonds, sustainability bonds, and especially these innovative sustainability-linked bonds actually differ in what they fund and how they work?
Okay, so social bonds, as the name suggests, must use their proceeds to finance or refinance projects with clear, positive social impacts. Think affordable basic infrastructure, access to essential services like healthcare or education, employment generation, particularly for vulnerable groups, food security projects, affordable housing.
Tangible social outcomes.
Yes, sustainability bonds are a blend. They finance a mix of both green, environmental, and social projects. So proceeds can go to renewable energy and affordable housing, for example, under one bond.
Got it. A mix. And the SLBs, they sound different.
Sustainability-linked bonds, SLBs, are particularly innovative and becoming very popular globally. Unlike the others, the use of proceeds isn't restricted to specific projects. Instead, the financial or structural characteristics of the bond itself are tied to the issuer achieving predefined sustainability performance targets, or
How
SPTs.
does that work? Like
Yeah.
the interest rate changes?
Exactly. For instance, the coupon rate might step up, increase, if the issuer fails to meet its pre-agreed targets, like reducing its carbon emissions by a certain percentage by a certain date, or increasing gender diversity in management. Conversely, sometimes there's a step down if they exceed targets.
Ah, so it creates a direct, measurable financial incentive or penalty for the issuer to actually fulfill their broader sustainability commitments.
Precisely. It links their cost of capital directly to their sustainability performance, which is a powerful mechanism for driving real-world change beyond just funding specific projects.
Very interesting structure. Okay, moving briefly from the policies themselves to the tangible output, the actual money in your wallet. Union Minister Nirmala Sitharaman recently inaugurated the new corporate office of the Security Printing and Minting Corporation of India Limited, SPMCIL, in New Delhi. What exactly is SPMCIL, and why is its role so vital to India's economy? We might take it for granted.
We probably do take it for granted. SPMCIL is a Schedule A Miniratna categorized central public sector enterprise. It was established back on January 13, 2006. Its core functions are absolutely vital to the everyday functioning of the economy. They are responsible for the printing and minting of currency notes and coins for the Reserve Bank of India. They also produce security paper needed for crucial documents like passports and postage stamps. They mint circulation coins, commemorative coins, and even get involved in refining bullion.
Wow, so they handle the entire life cycle, from paper to print to coin.
Pretty much. This organization, with its 9 production units spread across India, is literally responsible for the physical manifestation of many of the financial policies we've been discussing. They ensure the integrity, quality, and supply of the nation's currency and other secure documents.
The backbone of currency and security, indeed. Okay, let's move to our final section. Key appointments in constitutional bodies. Let's turn to an important appointment that will significantly shape future fiscal relations between the center and the states. T. Ravi Shankar, who is currently serving as a deputy governor of the Reserve Bank of India, has been appointed as a part-time member of the 16th Finance Commission. Why is the Finance Commission itself so critical to India's federal structure? What does it actually do?
The Finance Commission is a hugely important constitutional body. It's formed under Article 280 of the Indian Constitution. Its primary and most critical function is to recommend the distribution of tax revenues, the net proceeds of taxes between the union, the central government, and the states. It also recommends the principles which should govern grants and aid to the states from the center.
So it basically decides how the national pie of tax money gets divided up.
Exactly. This is a critical aspect of India's federal fiscal structure. Its recommendations determine how resources are shared across the country, significantly influencing state budgets, their spending capacity, and ultimately development initiatives nationwide. The very first Finance Commission was established way back on November 2010, 1951.
Right, so this is a body with a long and influential history. Who is chairing the current 16th Finance Commission? And when can we expect its recommendations? And for what period will those recommendations apply?
The current 16th Finance Commission was constituted by the Government of India in late 2023. It is chaired by Dr. Arvind Panagarya, a very well-known economist. It is expected to submit its recommendations by October 31st, 2025, so later next year. And these recommendations will then apply for a 5-year period, starting from April 1, 2026, running up to March 31st, 2031.
Okay, so its work will shape state finances for the second half of this decade. And Mr. Shankar is one of the members.
Yes, the commission includes the chairman and 4 other members. T. Ravi Shankar is appointed as a part-time member, bringing his RBI expertise. There are also full-time members, including economists and former senior bureaucrats. Ritvik Pandey serves as the secretary to the commission. It's a blend of expertise to tackle this crucial task.
Indeed. Well, we've truly gone on quite a journey today, from the intricate mechanics of unbundling government bonds, stripping them down, to refining lending norms for massive projects, exploring new avenues for digital transactions like ULI and Valid, looking at climate risk management through RBI cries, and even, the cultural promotion of financial literature in Hindi.
Yeah, it's been a wide range. And what stands out to me, really, from this deep dive is just how interconnected all these regulations are. They aren't happening in isolation, they're constantly evolving, trying to address that dual challenge you mentioned earlier, ensuring financial stability while promoting sustainable growth. From managing domestic financial health to integrating India more deeply and hopefully safely into the global economic fabric, it feels like a holistic approach to financial governance.
A holistic approach, constantly adapting. So, for you, our listener, wrapping this up, what's the key takeaway from all of this complexity? I think it means that while the world of finance can certainly seem dense, maybe even intimidating sometimes, understanding these key developments offers a really unique perspective. A perspective on India's economic direction and also on the dynamic forces that are actively shaping your own financial interactions, whether you're running a business, making investments, taking out a loan, or simply managing your personal finances day to day. So here's a final thought to leave you with, something to mull over. As India's financial landscape becomes increasingly digitally sophisticated, much more plugged into global markets, and now explicitly factoring in things like climate change, how might these rapid, often complex regulatory adjustments influence the everyday financial decisions and strategies for both businesses and individuals like yourself in the coming years? How do we navigate this accelerating change effectively?